Hi, I'm here today to tell you why it is important to set up your own financial arrangements independent of a financial advisor. Well, first of all, 95% of the population don't have access to a financial advisor because 95% of the population, according to the Office of National Statistics, have less than £100,000 of investable assets, and that's the threshold below which financial advisors typically won't see their clients, because if they're looking to levy fees of £1,500 a year or £2,000 a year, then it wouldn't be decent for them to service clients with less than £100,000 because the value they can add is disproportionately low compared to their fee. So this is a message for the 95% of the population that are disintermediated, orphaned and underserved by the financial industry. So why should you have your own independent financial arrangements? So what I mean by that in particular is investment products. Well, there are a number of reasons why. The first one is that you surely don't want to have to change your investment portfolio every time you change your advisor. I've found often is the case that an advisor moves from job to job, that the clients have to cancel the arrangements with the previous company, set up arrangements with the new company, and there's costs and charges involved, and also the inconvenience and time that it takes in order to move your investments from one place to another. So really, the investment should be independent of the advisor. It should be in one place. You should set it up yourself and use your advisor for what they can really help with, and where they can really add value, which is help on your tax or trust affairs and planning affairs. So they're meant to be financial planners at the end of the day, and that doesn't necessarily mean intermediating. The next point is the regulator actually appoints the financial advisor as a intermediary. They intermediate. They arrange financial products and services on their client's behalf, and that's why they have to be regulated, because effectively what they're doing is selling products. So your financial advisor is selling products. They are not necessarily a financial advisor or financial planner at all. They may simply be a facilitator of arranging transactions of financial products. Now, in the olden days, before 2013, the Retail Distribution Review, there used to be a commission paid to the advisor for arranging a financial product on your behalf, an investment product, a pension product, that sort of thing. Well, since 2013, that is meant to have been banned, so no longer do you get the commission-hungry salespeople, apparently. Actually, what happened was there was a lot of lobbying against the regulations that came in, and two things happened. One thing is that not all financial advisors were bound by the conditions of the Retail Distribution Review. For example, advisors in what we call vertically integrated firms, that is firms where the advisor belongs to the same firm for the product, those firms were exempt. So those firms can still pay what is termed commission to their advisors for selling the firm's product. A good example of that is the largest intermediary in the UK, which is St James's Place. So they can take fees from your products still, even though we're in a time post-Retail Distribution Review where that for the general populace of advisors is no longer the case. For the general populace advisors, what they did is they changed the name that they gave to commission, and they called it contingent advisor charge. So effectively they get a payment from your pension or for your investment, but it's contingent on you arranging that investment. So the vast majority of advisors don't actually get paid unless they sell your product. So really they're remunerated by the amount of products that they sell. So that's how they're incentivized, that's how they're driven, and it's not necessarily putting your interests first. It's not necessarily putting the client's best interests first, because their business model presupposes that you're going to put your investment assets with them, that you're going to run your life savings with them over the course of your lifetime, on which they're going to take ongoing charges. So yes, we may have got rid of the commission-hungry salesperson, but now what we have is a contingent advisor charge driven salesperson. And it's useful to break that link.